Welcome to this new class on the relationship between macroeconomic indicators and financial markets. If you've ever wondered how to anticipate market movements or better understand the global economy, this class is for you. Knowing these indicators will help you make more informed investment decisions and identify the best times to buy, sell, or hold assets. Don't forget to subscribe to the channel and turn on notifications so you don't miss any of our classes. Disclaimer: the content of this channel is for educational and informational purposes only. It should not be considered financial advice, investment recommendations, or an invitation to engage in trading in financial markets. Always conduct your own research and consult with a financial professional before making any investment decisions. Investments carry risks, and we do not guarantee any specific outcomes. If you're ready, let's get started. Macroeconomic indicators and their relationship with financial markets. Class objective: understand what macroeconomic indicators are. Learn how they are classified and what information they provide. Relate these indicators to economic cycles and financial markets. What are macroeconomic indicators? Macroeconomic indicators are data that show us how a country's economy is performing. They tell us whether the economy is growing, stagnant, or facing challenges. By looking at these indicators, we can get an idea of the present, past, and future of the economy. Simple example: if a country were like a company, these indicators would be the financial reports showing how the company is doing. Some of these reports tell us what is happening now, others show what happened in the past, and some help predict what may happen in the future. Classification of macroeconomic indicators. They are classified into three types. Leading indicators predict the future of the economy. Coincident indicators reflect the current state of the economy. Lagging indicators show how the economy was in the past. Simple example: if we want to know how the economy will perform in the coming months, we use leading indicators. If we want to know how the economy is today, we use coincident indicators. If we want to analyze what happened months ago, we use lagging indicators. Leading indicators predict the future. Leading indicators are useful for predicting how the economy will move in the future. Here are three key examples. ISM, US. This indicator is based on a survey of 250 US company purchasing managers, asking if economic activity will be higher, the same, or lower than the previous month. If most respond that it will be higher, it's interpreted that the economy will grow. IFO, Germany. A survey of 10,000 German companies about their current activities and expectations for the next 6 months. If the majority are optimistic, it is seen as a sign of economic growth. Though it's a German indicator, it is also used to predict the European economy. Tankan, Japan. A survey of 10,000 Japanese companies about their future economic expectations. It calculates optimism by subtracting negative from positive expectations. If the number is positive, it indicates optimism. Coincident indicators. The present. Coincident indicators show what's happening in the economy in real time. They are useful for measuring the current health of the country's economy. Some examples are: GDP, gross domestic product, measures the value of all goods and services produced in a country during a certain period, usually a year. If GDP grows, it means the economy is producing more. How GDP is calculated: we add consumption, investments, government spending, exports, and subtract imports. Inflation, the sustained rise in the prices of goods and services over time. It's measured with the CPI, Consumer Price Index, which tracks price changes of a basket of products. Indicators to measure inflation. CPI reflects price changes in basic goods and services. Core CPI measures inflation without including energy and food prices, which are highly volatile. GDP deflator measures inflation by considering all goods and services produced in a country. Interest rates. Interest rates are the price we pay for borrowing money. Central banks, such as the European Central Bank or the US Federal Reserve, set interest rates, influencing the economy. When rates are low, it's cheaper to borrow, boosting investment and consumption. Unemployment shows the percentage of people who are willing to work but cannot find a job. Unemployment rate It's calculated by dividing the number of unemployed by the labor force, people working or seeking work. Types of unemployment. Frictional. People leaving one job to look for another. Seasonal. Unemployment caused by seasonal changes, e.g., in tourist areas. Structural. When workers' skills don't match what businesses need. Cyclical, related to economic cycles. Exchange rate. Measures the relationship between two currencies. It can be fixed or floating, and its fluctuations affect a country's imports and exports. Lagging indicators, the past. Lagging indicators are released after events have already occurred, showing how the economy performed in the past. Some examples include price index, reflects price changes after they have occurred. Unemployment rate, though it gives a present picture, it often moves slowly and shows past effects. GDP, it can also be considered a lagging indicator since its data is usually published quarterly, after the period has ended. Relationship between macroeconomic indicators and economic cycles. Economic cycles have different phases that influence these indicators. Financial markets react to these changes. Phases of the economic cycle. Depression. GDP stagnates. Inflation is low and stable. Interest rates are minimal. Low confidence in the economy. Recommended sectors. Consumer products, logistics, transport, energy. Expansion. GDP grows. Corporate profits increase. Investment rises. Interest rates rise to control inflation. Recommended sectors. Technology, communications, cyclical consumer goods, finance. Stagnation. GDP growth is flat. Businesses lose confidence. Production declines. Recommended sectors. Basic industries, pharmaceuticals. Recession. GDP declines for 2 or more quarters. Market confidence drops. Consumption and investment fall. Recommended sectors. Defensive sectors like energy. Interpretation of economic indicators in financial markets. GDP. If GDP rises, companies are producing more and generating higher profits. This can boost their stock prices. Inflation. When inflation rises more than expected, central banks typically increase interest rates. This makes financing more expensive for businesses, potentially slowing investment and reducing stock values. Interest rates. If central banks lower interest rates, companies can borrow more cheaply, allowing them to invest more, which can increase stock prices. Macroeconomic indicators are essential for understanding how the economy is doing and predicting its future performance. Knowing these indicators and their relationship with economic cycles allows for informed decision-making in financial markets. In summary, understanding macroeconomic indicators is a fundamental tool for any investor looking to anticipate how financial markets will move. By knowing the relationship between these indicators and the phases of the economic cycle, you can adjust your investment strategy more precisely and take advantage of the opportunities that arise at each moment. If you found this content useful and want to continue exploring economic and financial topics, be sure to subscribe to the channel and leave a like. See you in the next class.